Good morning, and thank you for joining us today for our virtual conversation on Economic Outlook 2025, Key Trends and Implications for Businesses. I'm Rich Bradshaw. I'm the President and Chief Banking Officer for United Community, and I'll be leading today's discussion. We know more than ever that business leaders are navigating an evolving landscape, kind of daily right now, with shifting market conditions and regulatory changes. Our goal today is to provide insights into those trends and help you think strategically about the year ahead. I'm joined by two distinguished experts from United Community's private wealth management team. Both of their bios have been emailed to you. On my far right, Philip Rich, Chief Investment Officer, and to my immediate right, Kurt Schumacher, Wealth Strategist. Over the next 30 minutes, we'll talk about economic trends shaping 2025 and beyond, potential regulatory and policy impacts, and key financial indicators to watch and actionable insights. Before we dive in, a quick note, we'll have a Q&A session towards the end, so feel free to submit your questions within the Q&A panel as we go along. All right, let's get started. First, Philip, let's start by setting the stage with the broader economic outlook. To help break it down, let's look at four key indicators business leaders should be following: GDP growth, inflation, employment, and my favorite, interest rates. Let's start with GDP growth. What are the current expectations for economic growth in 2025, and how could that impact businesses across different industries?
Okay, thank you, Rich. We really come into 2025 with a lot of strong momentum coming out of 2024. And our growth, although it may not feel so fantastic right now, it's really very strong compared to the rest of the developed world. Our most recent read was in the fourth quarter of 2024. We were up 2.3%. That's solid. Anything above 1% is solid. 3% may be the upper bound, but 2.3% is solid. The rest of the developed world did about 1.7%. So we're well ahead of the rest of the developed world. The strength in our economy is coming primarily from consumer spending and services. In 2024, we saw a lot of weakness in manufacturing, and that may persist into this year, although so far this year, manufacturing has seen a bit of an uptick. Another great strength that we have had is demographic elasticity, and this is different than a lot of countries around the world. We've added over 4 million workers to our workforce since COVID. Workers are productive, they earn money, they spend money. That's a positive. We also had, coming out of COVID, very generous fiscal and monetary stimulus. Now, that helped feed our inflation problem, but let's not ignore the fact that it also fed a lot of our growth. Right. A lot of that is related to the stimulus. The early indicators for 2025 do indicate some slowing in the economy. Consumer confidence appears to be shaken here. Consumer spending actually went negative in January, and without the consumer, there is no U.S. economy. I'm sorry, but that's the way it is. The Atlanta Fed's GDP Now model actually is right now negative. It's not a good predictor of where GDP is going to end up, but it is frequently directionally correct. And right now it's sending negative signals. Even manufacturing has jumped in the last 2 months, in the first 2 months of 2025, but there's some concern that may be demand being pulled forward out of concern about future tariffs. Recently, our Treasury Secretary warned of an economic detox. Let's hope it's not a 12-step program. And even the president wouldn't rule out recession the other day. But I'll sort of wrap up here with a bit of a story. I was in Florida last week with a lot of our clients. And at this event, a number of clients came up to me and said, Philip, tell us about these tariffs. What's going to happen? What does it mean for my business? And they asked these questions with increased urgency. And these questions have a tendency to answer themselves because anybody who asks those questions with that kind of urgency is not in the mood to make a big new business investment or hire a bunch of new people. So let me just sort of summarize all these cross currents. The economy is still growing, but not as fast as last year. And suddenly recession is back in the conversation. I don't think the probabilities are there, but it's back in the conversation. The US is still the strongest economy amongst the developed nations. And I'll end just by coining a phrase, I'd rather be here than anywhere else.
Well, those are great insights. Thank you. Inflation has been at the top of mind for businesses, especially with some of the recently imposed tariffs. How do inflation trends currently look, and what impact could they have on business costs and pricing strategies?
Yeah, well, inflation is much improved from the 9.1% that we saw late in 2022. The problem is progress now appears stalled at about the 3% level, and that's the most recent read we have. Lower energy prices or declining energy prices helped the inflation picture throughout 2024, but now they've flattened out. They're no longer helping. The Fed target remains 2%, so we're still well away from that 2%. And here, I'll just throw in another anecdote. I was at the grocery store the other day, and I had to go look because it's been in the headlines. I had to go look at the egg section, and you can buy a dozen eggs here in Greenville for $14.50. Now, Rich, these are very good eggs.
They must be very good eggs.
They're pasture raised, hand tended, organic, of course. But right next to them, you can buy a dozen eggs for $6.50. Now, that's still a high price, but it turns out that once they're in the omelet, it's hard to tell the difference. So there's a lot of substitution going on in the economy. Consumers will grab those $6.50 eggs before the $14.50 eggs. And substitution is fine. It helps attenuate the impact of inflation. But on a broader scale, it can also do some economic damage. Every time we go out to eat, we have the choice to stay in. So restaurants are being hit by all this. Restaurant, dining, housing, auto sales, these are the areas that are being hit.
Thank you for sharing those areas. I'm going to ask you though, because we have a lot of people on
Right.
the television here. I'm going to call it the television, but any other industries that have been impacted?
Yeah, I mean, agriculture in general, and we feel this here in the Carolinas, agriculture is still a really important part of what we produce in the Carolinas and in the Southeast in general. And we see this, of course, carry through to food costs. Housing prices are very elevated and are impacting affordability, but there has been a recent break on rents. Rents in the beginning of 2025 have actually started to trend down. Used autos have been hit. Why? Well, because the new ones are so expensive that the price of used autos is being pulled up. And the other area where we're seeing a lot of inflation is insurance, all kinds of insurance, really expensive right now.
All right, thank you. Let's talk about employment. What's the outlook for the labor market this year, and how might hiring trends or wage growth affect businesses?
Yeah, we're seeing really solid job growth here, 151,000 new jobs in February. That's our most recent number. Unemployment did tick up to 4.1%, but still not in a problematic area. 4.1% is good, not great. We need 100,000 jobs just to keep up with growth in the labor force, to give some context to these numbers. Job growth has slowed since the immediate period post-COVID, but it's still solid. Wage growth has moderated down to 4%, and at that level, it's no longer stoking inflation. Both labor costs and availability could be impacted by tighter enforcement of our immigration laws. That's just a fact. But here's another important fact that doesn't get a lot of attention. Productivity has really been strong and improving since COVID. And productivity is really important because productivity both supports growth and it's an antidote to inflation. When our output grows faster than our inputs, our costs, that's anti-inflationary. So good news on the labor front.
All right, thank you. And finally, my favorite subject, interest rates. Businesses have been navigating a higher rate environment, but we received a little relief late last year. So what's the outlook for interest rates in 2025, and how could that impact borrowing, investing, and cash management decisions?
Yeah, well, like so much of what I've talked about, it's a bit of a mixed story. The futures market right now has signaled as many as 3 rate cuts this year from the Fed. And remember, all the rate cuts impact the short end of the yield curve, overnight rates. However, Fed members in their own rhetoric are much more hawkish. They're still focused on getting inflation down to 2%. However, if growth in the economy breaks down, that tune will change. It's really the concerns regarding inflation and deficit spending that have been holding up those intermediate rates. And it's the intermediate rates, not the short end, that impact borrowing costs the most. Now the possibility of an economic slowdown is starting to pull those rates down too. Mortgage rates were above 7% in January. They're now closer to 6.6%. I will say, though, on the availability side, capital availability is still pretty good. Some banks are tapped out, meaning that their entire deposit base has been lent out. We don't have that problem here. We're open for business. We want to make good loans. But a combination of high rates and the shrinking of the Fed balance sheet, which effectively drains liquidity from the system, makes for what is still a restrictive monetary environment.
All right, well, thank you, Philip. Kurt,
Yes, sir.
deregulation and tax changes have significant implications for both business and personal planning. What potential changes should folks be aware of this year? Let's start with deregulation.
Sure. Well, we know that the new administration has a real focus on deregulation. We know that from the president's own statements, and I think most or all of us have seen the images of Elon Musk with his chainsaw
Yes, we
in the
have.
Oval Office. So we know that the Trump administration cares about deregulation. By way of background, there are really 3 ways that this can happen. You can remove, what we're talking about here is removing regulations from the Biden administration. So we can remove those key regulations either through congressional action, which would be nullifying. We can overturn a regulation through a judicial action or decision, or the executive branch and the Trump administration can rescind a regulation. I think what we're going to see here is a lot of rescission, followed up by a fair amount of judicial action, which will either confirm the overriding of the regulations, the repeal of the regulations, or perhaps challenge them. But so far, we know that really 3 major steps have been taken by the administration. On January 20th, the Trump administration released a moratorium that was called regulatory freeze pending review. And what this really did is it just stopped all rulemaking processes in the government, including for rules that were under development or already in the proposal stages. It seems pretty radical to some people and worrisome, but it's actually not at all unusual. If we go back to 1980, whenever the administration has changed from one party to the other, a similar rule has been put in place. So Presidents Reagan, Clinton, George W. Bush, Obama, President Trump the first time, and President Biden all basically did this. What's a little, I don't want to use the word shocking because that has a negative implication, but more noticeable is maybe the next 2 things, the next 2 steps. One is the passing of the 10-for-1 rule, which essentially says that any agency that wants to pass a new regulation going forward has to repeal at least 10 existing regulations. And significantly, the net cost of the new regulation has to be negative. So we have to save money, the cost of the new regulation, when we adjust for the regulations that have been rescinded. So that is a major step that's been taken. And then the second major step that's been taken is what a lot of people are now referring to as essentially deregulation by firing. And I'll just give an example there. The National Labor Relations Board is a 5-member board, makes a lot of important policy. It was down to 3 members due to retirements and resignations, and the administration recently fired one of those 3 members, leaving only 2 members. That is not a quorum. That board cannot act. As one commentator said, and just to quote him, the legal protections granted to workers by law exist if there's only if there's a bureaucratic framework to enforce them. And that's going to be a really important question going forward. It could also play out in the IRS, where if we don't have enough agents to enforce tax laws, then we'll see what happens there. So I'll pause there. I think that's where we stand right now with respect to deregulation.
Are there particular industries that could be impacted in the short term?
Absolutely. As Philip has said, a lot of things are uncertain right now, and that is true here as well. But it seems like there's really a consensus that 4 or 5 industries are going to see significant effect. And I'll just go through them very briefly. We can talk about them more later if we want to. No doubt financial services and banking are going to be affected under the current administration. And I will just mention 1 or 2 points there since it affects us directly.
Sure.
A headline I saw last week, the SEC explores regulatory changes to make it easier to raise capital, invest in private funds, and be a public company. Moreover, key advisors, including Mr. Musk, have been pretty vocal about wanting to actually eliminate entire agencies, including the Consumer Financial Protection Bureau, the FDIC, and other key agencies. Whether that happens or not remains to be seen. But what we do know is we're at least going to have a more permissive environment in the financial services space, which actually can be great in some respects for those who are listening, because it's going to allow us more flexibility to serve our good customers well.
I agree.
And more briefly on the others, I think we're going to see significant advantage to pharmaceutical and healthcare companies. There's pressure to roll back the Biden policy, which allowed Medicare to regulate drug prices. There may also be renewed attempts to overturn the Affordable Care Act, Obamacare, which could have effects in this area. I think energy will see a significant shift. We're already seeing it in messages from the CEOs as we shift towards maximizing oil and gas production and shifting away from climate change initiatives and green power initiatives. That'll have a broad effect on manufacturing industries, factories, power plants, but it's also going to create whiplash for some companies like automakers who have started to comply with Biden administration regulations and now may be incented to shift back away from those. 2 more that I'll mention. Technology. We're going to have, I think, a more permissive environment for artificial intelligence, less regulatory environment there. We're likely to see a slowdown in antitrust actions against big tech and less regulation of cryptocurrencies. So deregulation is going to affect the tech industry. And lastly, I'll just say that any business which has a highly regulated labor force is likely to see significant effect during the next 4 years. Notwithstanding some of the support that President Trump got during his campaign, I think it's probably fair to say we've got a fairly anti-union, potentially anti-labor stance, or a pro-business stance if you prefer, going forward.
All right, thank you. And with the new administration, I understand there are some tax changes on the horizon. Would you talk about some of those, please?
Absolutely. Rich, if it's okay, I'll just preface this. Notwithstanding my 25 years as an attorney prior to joining the bank this year, we don't like to give tax or legal advice. But having said that, I'll try to shed a little bit of light on what's going on.
Appreciate that.
The president's speech to Congress last week, on March 4th, he talked about 6 or 7 tax matters. Most of them aren't directly important to us. I'm not going to spend any time on them, but he did mention wanting to stop taxing tip income, stop taxing Social Security income, which would be really significant, but really costly and possibly not doable. Not taxing overtime pay. He talked about tax incentives for shipbuilding, and that was done in the context of talking about perhaps wanting to take over the Panama Canal. Talked about changing the deductibility of auto loans in order to support domestic auto producers. So those were all mentioned, but again, not super important to talk about here. I think what's more important is that he mentioned a return to full bonus depreciation. That would restore a provision of his 2018 or his administration's 2018 Tax Cuts and Jobs Act. And if I just refer to the 2018 tax bill or the Trump tax bill, that's what I'm referring to. It is set to phase out at the end of this year. And I'll actually quote the president here. He said, as part of our tax cuts, we want to cut taxes on domestic production and all manufacturing. And just as we did before, we will provide 100% expensing. It will be retroactive to January 20th, 2025. We don't really know the scope of this proposal or exactly what it'll apply to, but it certainly signals a desire to support businesses, particularly domestically focused businesses, by allowing them to take all of that expense upfront without having to amortize or depreciate it over time. Of course, additional priorities that we know are significant. We have the tariffs. You can debate whether or not a tariff is a tax or not, and I don't want to get into that here, but it certainly is significant and has a tax-like effect on consumers. I'll just mention briefly, tariffs have been mentioned in the media, according to, I think it was Bloomberg. Basically mentions are up 400% from any time during the prior year over the last 3 months. And it's significant because it really does create uncertainty, both at a macroeconomic level and at a business level, as Philip alluded to earlier. At a macro level, they potentially create inflationary pressure, makes it harder to lower interest rates. And that is leading to a lot of the talk that we're hearing about stagflation or slugflation, which that is something we don't want to talk about, but it certainly is out there in the zeitgeist right now.
A new economic term.
Slugflation, low growth with inflation. But more importantly, at the company level, it really creates uncertainty.
No question.
Yeah, we saw Diageo a few weeks back saying that they just weren't going to issue first quarter guidance because of the uncertainty created by the potential of the tariffs effect on alcohol that they bring in through Mexico. Additionally, really important, the president has focused on returning, or he wants to lower the corporate income tax rate to 15%. It had been 35%, cut to 21% under his tax bill in 2018. And President Biden consistently favored raising that back up to 28%. So it's likely that we'll at least have the 21% from the 2018 Job Act. But if that were to be reduced even further to 15%, that would be significant to a number of our listeners today.
That'd be material.
Yeah. And then lastly, and perhaps most importantly, the president has a real priority, and he seems to be supported by Congress in this, to just extend his tax cuts from 2018. They are set to expire at the end of this year. If they expired, top personal rates would go higher. The standard deduction would be cut almost in half. There would be what we would consider as individuals negative changes to the child tax credit, qualified income business deductions. There would be a number of other changes, but very significantly for a lot of my clients in the wealth group, the gift and estate tax exemption would be cut in half. It is almost $14 million per person right now, which means if you're married and you've done proper planning, you can protect at least $28 million of wealth that you leave for children and grandchildren. If the Trump tax cuts from 2018 were to sunset, that would be cut back to $7 million per person. So there's a lot of, assuming that this does get extended, and I think we all think that it will, there's a lot of planning opportunities that arise with these higher exemptions.
All right, great. Thank you. I think. I believe we can all agree that there's been a lot of changes introduced since the new administration took office. As business leaders look to navigate the months ahead, what indicators would you recommend they watch most closely? And Philip, let's start with you.
Yeah, I mean, there's really two big ones, growth and inflation. And include growth in your particular industry, but these are the two indicators that will determine Fed action going forward. And, an especially bad outcome would be a bout of stagflation, because if you have low growth and high inflation, it really puts them on the horns of a dilemma. But I'll go back also to and throw in my third bonus indicator, and that's productivity. The advent of AI, if it has anything like the impact of the PC revolution, could change fundamentally productivity in America. I realize that all this still has to play out, but I come back to productivity because, again, it supports growth and it's an antidote to inflation.
Thank you. I appreciate that. And Kurt, what are your thoughts?
Well, in terms of indicators at the personal and business level, we still have a lot of uncertainty. We don't have changes in the tax law yet. We don't know what regulations are going to come down the pipeline yet. So I think about a couple of things. First of all, cash is really optionality. If you have cash or can accumulate cash, that gives you the option to purchase assets potentially at better prices, or to make business moves or mergers and acquisitions down the road when the time is right. So this may not be the time quite yet to make major changes or take big swings, but it's time to get ready and time to think about it should the opportunity arise. On the regulation side, following up on what I said earlier, we know what we can expect. We can expect uncertainty in the short term, but in the longer term, less regulation, less oversight, and lower compliance costs, and a more permissive environment for deal making and for mergers. So regulated businesses right now, I would recommend, should really be preparing for that uncertainty by reviewing the entire landscape of regulations that might apply to their particular business, and their operations and really think about how would my business change if key regulations were changed for the better or for the worse? Probably for the better in a lot of industries.
Makes sense.
And this is a great time to think about how you would deal with that change. And it might be a great time to reach out to your congressmen, your senators, your other representatives, or to participate in kind of public comment periods as these rules are changing going forward. On the personal side, and we're thinking about taxation, I'd like to stress the fact this is a great time to make sure that you've got the basics right. Because we don't know exactly what the world's going to look like in 6 months. But what I do know is that as I review clients' wealth plans and their estate plans, even clients who have been super successful and their businesses are kicking out a ton of money, they've often missed what I would call some of the block and tackling. So they have an estate plan that was done 15 years ago and is wildly out of date. It might, for example, provide for assets to go to the children, a third at 25, a third at 30, a third at 35, which is really not appropriate for a lot of the people on this call. We want to think about a plan that not only maximizes tax benefits, but protects assets for children and grandchildren through the use of dynasty trusts. We want to think about getting assets, high growth assets, potentially outside of the estate so that that growth happens outside of the estate in case 10 years from now, perhaps when we have a different or more liberal administration, the exemptions get shrunk back down. And for business owners, I'm shocked at how many times I see successful businesses where there's not a buy-sell agreement in place, or where the buy-sell agreement, which governs the relationship between the partners or the members, was done as a page in the original operating agreement and is wildly out of date, or the value for the business or the formula is wildly out of date. We can talk all day about minor changes in the tax code that will affect our businesses or deductions, but if your estate plan's out of date and you're paying a 45% estate tax, or your business is worth $100 million, but your buy-sell agreement is no good and your partner dies or wants to get out of the business, those losses are potentially much worse. So I would really focus on that kind of stuff now. Get with your advisors, your CPAs, your wealth advisors, or we would love to talk to you here at United Communities Private Wealth Group. Make sure that stuff is in place, and then we can focus on how cash flow will change as the new rules come into place.
I think that's really good advice. Thank you, Kurt. Philip, from a market investment perspective, where do you see opportunities for businesses to strengthen their financial position?
Yeah, I think it's always, when you have this much uncertainty out there, it's really good to focus on fundamentals. What is your core business? What are your key competitive advantages? Kurt already mentioned strong liquidity on the balance sheet is a great defensive posture. Hedging interest rate risk with swaps is an idea that most of our clients should be looking at. This probably isn't a great time for extravagant new adventures. At the same time, uncertainty creates opportunities that come up out of nowhere. And the key is to be prepared to take advantage of those where they occur.
All right, fantastic. All right, I'm looking at the time. We have time for one or two quick questions from the audience, and we've got a few in. How might the recent escalation of trade tensions between the United States, Canada, and Mexico, by the way, all three have new leaders in the last 30 days, including the implementation of new tariffs, impact businesses in terms of costs, supply chain, and market access? How about you, Philip?
Yeah, well, it impacts an awful lot of business, probably agriculture and manufacturing more than others. I was amazed to learn that, many of the automobiles that are assembled right here in the United States have parts that cross international borders up to 7 times before final assembly. It's really remarkable how integrated North America has become in the manufacturing process. Agriculture has potential to be hit 2 ways. First of all, reciprocal actions on tariffs could affect them, but inflation, all of their inputs, energy is a huge input to agriculture, and it's already been hit by inflation. So I think manufacturing and agriculture are 2 of the most vulnerable areas.
Okay, excellent. Thank you. And what are some of the practical steps we can take to manage cash flow effectively in a higher interest rate environment? And how about you, Kurt?
Sure. I think that question may have come in just before my last statement, because I think I kind of hit on some of those points, but I'd like to emphasize something that maybe I didn't, which is that we really want to make sure that we're coordinating our planning, whether it's with respect to cash flow or personal planning and business planning generally, so that we're taking into account together estate planning or transfer tax planning more generally, because that could be gift and generation skipping planning. But we need to think about transfer tax planning side by side with income tax planning now. And then if you are a business owner, you have to integrate business succession planning into that conversation. So you have to be working with advisors and attorneys who can help you with all three of those things. Particularly if we get, as an aside, if we get a decrease in interest rates, if we get a slowdown in the economy, Fed lowers rates significantly, there are a number of planning opportunities on the personal and business side that just don't work as well with higher interest rates. So we can look at things like grantor retained annuity trusts, sales to intentionally defective grantor trusts. There are certain charitable vehicles and trusts that work better at lower interest rates. So taking advantage of that high exemption and low to mid rates, there's just a lot of opportunity there, and we don't want to miss out on that. And of course, we're happy to help with that if we can.
Thank you, Kurt. Well, that brings us to the end of our discussion today. Thank you to Philip and Kurt for sharing your insights with us, and thank you to all of you for joining us. If you'd like to continue the conversation or have specific questions about your business strategy, our team is here to help. We're really excited about the expanded capabilities we have to offer through United Community Private Wealth. Those include investment management, business succession planning, fiduciary services, estate planning, retirement and tax planning, banking, and loan offerings. We'll also follow up with a summary of today's discussion and additional resources. Thanks again, and have a great day.
Thank you.